And on today's show, what deductions rule the roost in income tax planning? Part 2 of this week's series on end-of-the-year tax planning for 2014 with top producers Mike Kilbourn, CLU ChFC, and Rob O'Dell, CFP. Hi everyone, I'm Steve Savant, syndicated financial columnist and contributing author to Innsmark, Life Specs, and Backroom Technician. Let's get down to business. Well, welcome to the show, Rob. Mike, well, welcome to day 2. I mean, we're talking about all that's taxes. And what we're doing with our advisors today is we're really actually educating them in areas that they can actually go to their client, have immediate impact on their taxes. Everybody's saying, how do I find premium? How do I find premium dollars for some of my other things that I want to do, whether it's long-term care, annuities, life insurance, disability? Well, these are some of the tactics that free money up for us to be able to do that. But I want to talk about deductions today because right now, those are the things that rule the roost. And in the minds of people who are doing taxes today, I don't know about you, but if you're in a tax bracket like I am, I need every deduction I can get. So let's walk me through some of the high-end issues of what we're looking for in today's show.
Sure, let's talk about the deductions as individuals get on itemized deductions on Schedule A. Itemized deductions consist of the big ones here that we all know about. I'll give you examples. Medical, which is subject to some phase out there.
Charitable.
You have charitable, which is unlimited and not subject to alternative minimum tax. You have state and local and real estate taxes here. Professional fees, which are subject to AMT, and mortgage interest.
Did I just hear you say there's no limit on charitable? I always thought it was like 50% or something of that
nature.
Well,
in terms of there's no AMT limitations.
Oh, there's no AMT, okay.
Yeah, it does not affect AMT one bit. The other ones have AMT implications there. It does not reduce adjusted gross income, but it reduces taxable income. And there's a difference. It's a below-the-line deduction right here. And AMT, some of these are throwing back into it.
Now you have to really watch this because so you might get greedy in your deductions. You start deducting, all of a sudden you fall into the automatic AMT, and you probably shouldn't have filed it, right? I mean, we really have to walk through the math here.
Right.
And if you're in a state that has no sales tax, it's quite possible the state allows you to take a deduction for, it has no income tax. You get a deduction for sales tax, like Florida, where I come from.
Right. Now, if we go into itemized deductions, there are several that are very significant deductions. One is something not a lot of people know about is qualified long-term care contracts, premiums paid on that. You can write a portion of that premium off on your itemized deduction, Schedule A, or not miscellaneous, but medical expense.
Is that based on age then? Or?
It's based on age. And so, for instance, a 50-year-old can write $700 off. Now, he may not be able to utilize that because there's a phase out there. But for someone in their older, he or she can write off $4,600 per person for qualified.
I noticed when you get into the 60s, it becomes an issue. It becomes a
meaningful.
Big target deduction.
Right. So that's a real big one. It is subject to phase out. And phase out, if you're over 65, it's 7.5%. If you're under 65, it's 10% of adjusted gross income. For instance, if someone makes $100,000, 10% of that is $10,000, and that's how much is phased out as it relates to the medical expense. So they may not get this benefit, but for someone with lower income, they could likely use this deduction.
I think people don't address this, and most planners are still on the fence whether they should use long-term care in their planning anyways. But this is a huge area to bring to table because now it brings a little economics to it. I'm not just paying the premium, waiting to see if I'll use the benefit or not. I'm getting a deduction.
That's correct.
Well, walk me through this next one because that's a significant issue, especially for our advisors.
Well, as tax rates go up and we have positive market gains, we're seeing a renaissance in charitable planning, charitable giving, if you will. And we're seeing things like clients setting up charitable remainder trusts, especially now with a healthy 5-year bull market run and higher tax rates. They're becoming much more popular. And one of my favorite topics is donor advised funds, which is a poor man's foundation, which you can give low basis stock to a donor advised fund, receive the income tax deduction, which you do it, and then you can spread it out to the charities later on.
Now, Mike, you're known, you have your book out that's huge, Disinherit the IRS. I love it. We'll be talking about that next week. But I don't you deal with this all day long?
I have a whole chapter on charitable remainder trusts that tells you it's a wonderful, very win-win tool that I call it synergistic, and because your family wins, charities ends up winning, and you actually during your lifetime have more income, not less. And so we say, well, how can that work? And it does work, and we'll probably cover that in a future show.
Cash, my fave.
Right.
How do we play on this?
Well, for people who do not have low basis assets, they just have cash, it's a good asset to give. It's very straightforward. But they can deduct up to 50% of their adjusted gross income if they give it to a public charity. Now, if they give it to a private family foundations, which are much more rare, they can deduct up to 30% of their adjusted gross income.
So if you're in an IRS approved, and it's a 501c3 or whatever it is, I can give up to, and especially if I'm just sitting on cash anyways, I'm not going to use it, I can give up to 50% of my AGI on that.
That is correct.
Now, did you see a lot of people do that though, Mike?
Actually, it's rare when you see cash, but they usually take advantage of the capital gains type of property like stocks, and there you get a 30% deduction for your against your AGI. And if you can't use the deduction all this year, you've got 5 more years to use it. So
carry forward.
Sometimes we work backwards when we do some planning to make sure they can use all of the deduction they create with the charitable gift today.
So if you can't use it, you can still use this year's and push it forward 4 more.
5
more years. Total
5 more
6
years.
this year
Total
plus
6.
5.
Right.
Yep.
Well, when I come back from the break, I want to talk to you about this low basis assets. I want to walk through the mechanics of this to make sure we get it before we get into our meat and potatoes, which is going to be where we're going to be talking a little bit about what business owners can do. It's not how much money you make for your clients, it's how much money they get to keep, especially in retirement. But retirement income could cause Social Security benefits to be taxed. One tax advantage alternative is life insurance designed as a non-modified endowment contract that can generate tax-free income without taxing Social Security benefits. These contracts offer differing funding options depending upon your client's risk tolerance. For more information on how life insurance can be part of your retirement planning, just email me at steve@downtobusiness.tv. Brought to you by Ash Brokerage, the practice enhancement company. Welcome back to the second segment. I'm with Rob O'Dell and Mike Kilbourn. Rob, we're going to talk a little bit about low basis assets here. Walk me through that and the mechanics of how I can get some deduction.
Well, it's always better to give a low basis stock or mutual fund to charity versus cash. And so if you give that, the tax code or how much you can take as a deduction changes. So if you have a long-term asset, meaning held more than 12 months in one day, you can deduct up to 30% of your adjusted gross income. If you give that same asset to a family foundation, you can deduct up to 20% of your adjusted gross income. Now, a short-term asset is defined as something that's held less than 12 months. And so if you bought a stock, it did really well in 11 months, and you give it to charity, you deduct the basis of that asset, but you can deduct up to 50% of your adjusted gross income. But you still avoid the capital gain there. So knowing the phases where the adjusted gross income is very important.
Mike, do you focus on this very much as a planner?
Oh, absolutely. My clients tend to be a little bit older because they're in the serious estate planning phase of their life, and they look closely at these types of deductions that come with the charitable giving.
When we're talking about business owners and what they want to do, I'm thinking like in the old days, I remember when Section 79 ruled the roost. I mean, I would just buy myself until I hit the limit, and then I wouldn't worry about the 3-year or 5-year property.
Yeah.
So what's going on today, in Section 79?
Well, Section 79 is the $50,000 deduction, or you get the deduct premium on $50,000 of life insurance in Section 79. So that's
for business owners,
for
not
business
individuals.
owners. That's correct. For business owners, and offered as a perk for their employees.
So, and do you see many people playing in this, or are they just doing non-qualified now? Is this still a play?
Much more non-qualified happening we're seeing there.
Okay, and when I'm looking at that, I'm thinking about if I'm looking at non-qualified because of the participation issues and things of that nature with the employer,
yes.
I'm looking for things that I can really like. And I notice you have LTC up here for C Corps again. Now, they get to deduct it fully, but does the employee, does he get to take the money out benefits free?
Well, that's, long-term care, yes, they do.
They do.
Yeah.
So the deduction's up front and then straight. I don't know too many places where I can get the deduction up front and get it free coming out the back door.
This is an exception here, but that's for C corporations, not S, but C corporations. So if you have a client who has a business at C Corp, they have retained earnings, this is a great place to purchase long-term care.
That's worth exploring, especially if you have an owner of their own corp and they want to get some long-term care for themselves and they're possibly
would future planning actually think about reconfiguring maybe from an S or LLC to maybe a C?
That's a big move.
Yeah,
that's a very big move. Big implications there, whether they would do that or not. I've never seen that done. Right.
So what about planning fees? Now, what fees are we talking about besides the obvious one? I have to pay my CPA to do my taxes.
Right. Well, I'm a fee-only financial planner. So when I work with small business owners, they hire me and pay me from their business. Doesn't matter if it's an LLC, C Corp, or S Corp, and they pay us there as an executive.
Well, let me stop you there. I think most of our advisors understand CPA. He does your taxes. He does an audit. Whatever that fee is, that's it. That's deductible. But if an RIA is doing full-blown money management, all your assets and everything else, whatever that annual fee is, or quarterly, however they charge, however they bill, their billable hours, is that all included in this?
It would be the planning-only fees, not the investment advisory, but the planning only. So clients will pay me a fee. I will do the financial plan for them. There's no product sale. There's no investment advisory work, and they pay me out of here.
In your mind, then, and if I'm hearing right, it's partitioned. I have my plan, the actual
Right.
physical plan,
Right.
and the other one, oh, here's the investment itself.
Right.
Correct.
So if you're talking to a business owner, you would suggest that they maybe pay the bill from their business to make sure that they get the deduction when you're talking to them about what the fee is. In fact, maybe that makes it easier for making the decision to have the planning done, because I watch clients, they'll suddenly realize that they can deduct the fee, and suddenly the decision was made much easier.
So that's really a powerful thing. And of course, part of our audience is registered investment advisors, fee only. And so this is part of your practice. This could be a huge implementation if you haven't thought through this. And what about retirement plans at large? I mean, there's so many qualified plans, and should I be under ERISA or not? But there's some deductions to be had here, so let's talk about them.
Right. Well, the big one is the 401k plans, so solo 401k or regular 401k, where you can get an immediate income tax, write off your income taxes right there, reduction there. And so there's different levels and phases that you can deduct, but we'll get into that in future shows.
Yeah, we're going to have a future show that's going to cover how to completely eliminate the whole ERISA issue and be able to have a plan that could really allow you to retire at any time and put in any amount per year. And that, actually what we're going to talk about is a charitable remainder trust. Actually, we're going to talk about a NIMCRUT, Net Income with Makeup Charitable Remainder Uni Trust, and that'll be a future show.
Wow, I hope I can get that all in one sentence. So in retirement plans, do we really care what it is, whether it's a 401k or a 412I or whatever? Does it matter?
It does matter. Absolutely does.
Okay.
It does. So you want to look at your client and find out what their needs are. Is it a one-person sole proprietor? Is he working for a large corporation? Do they have it available to them? Do they have a plan available? So you want to make sure you know what kind of plan you're going into. It also has impact on Roth conversions, which we'll get on an income tax planning show when you do Roth conversions, whether they have a 401k versus a SEP IRA. Big difference when it relates to conversion.
When I'm looking at 401ks and looking at it, of course, we're very, very up for, I want to encourage a person to use it, especially if they're in a very high tax bracket, and especially if their employer is matching their contribution. I think
That's free money.
That's free
Absolutely.
money.
Well, they're crazy not to do it. That's 100% return on the first dollar you put in, and then there's the 3% or whatever more they add on top of that, so additional money they can put in.
Well, that's all the time we have for today. Remember, before moving forward with any of the ideas on our show, always consult your tax advisor, legal counsel, or your broker-dealer compliance officer. Missed an episode? Just hop out to our video archives. And remember, you could be wiser as an educated advisor. I'm Steve Savant. We'll see you tomorrow.